What's going on, guys? Welcome back to the channel. So in this video, we're going to discuss some of the largest, worst mistakes that people make when they invest into the stock market. Now, we see two people right now coming into these videos. We've seen sort of an influx on this channel, people who are salivating over the fact that the markets are quite low compared to what they were a month ago. And then there's also the people who dumped their life savings into the market last month and lost a lot of money. So regardless of who you are, where you are, how much money you have to invest, I would ask that you subscribe to the channel. I don't know where I was going with that, but hey, anyway, let's get started with this video and let's talk about some of these mistakes that people make. There's about 7 here in this video. Hopefully you can find some value. If you do, don't forget to hit the like button. We'd appreciate all the support on the channel. We try to put out as many videos as possible on these topics. So one of the first mistakes that people make is they buy high and they sell low. Wow, that's great, Nate. Thanks for the advice. It's so obvious of a thing, but really, when we're referring to this, saying that people are buying high and selling low, what we're really referring to is when people who, for example, dump their life savings into the markets at one specific time can end up getting bitten pretty bad. So I actually had somebody email me last week. I couldn't make this up if I tried. They emailed me the last week and they said, Nate, I invested my life savings in January into the stock market. I'm down over 30% in the past 2 months here. I'm very worried. What should I do? Well, first of all, I can't tell him what to do. I'm not sure what he should do. But what we like to tell people to do, or just to try to give some different pointers from my perspective here. Obviously, I'm not a financial advisor, but one thing that I really think is smart is to try to average investments in over a period of time so that you don't end up buying at all-time highs and ending up losing quite a bit of money. Now, is he going to make his money back eventually? Probably, depends. But this actually goes for people who might be watching this video right now, who might be salivating over the fact that the markets are down from nearly 30,000 points on the Dow to less than 20,000 points on the Dow. People are thinking, wow, this might be a great time to invest. But look, there's a couple of things that we also need to go in here too. And one of them is that I see people who are looking at the markets now and they are dumping all of the money that they can possibly find, all of their cash. They're going all in right now because they're absolutely certain that we are at the bottom of the market, or they are absolutely certain that it is such a good deal to buy stocks right now. This is actually something that I would also advise against doing, going all in at one time, even if you think that the markets are very, very low and they have nowhere to go but up, because the truth is you could very well be wrong. And that actually leads us into our next point here. The next mistake that people make is overconfidence in their own abilities when it comes to investing. Now, this is actually something that I kind of ran into. I don't know if it's ego or if it's just kind of thinking that for some reason you can't make mistakes, but sometimes we can become overconfident in our abilities when it comes to investing. So the best way to combat this is to simply make sure that you're doing some checks and balances. So when I invest into any companies, when I make any large investments for anything with my assets, usually what I'll do is I'll call up a number of people, a lot of them my friends, associates, my brother even, and I'll talk to them and say, hey, here's my thought process. This is what I'm thinking. These are the financials. Take a look at them. Call me back tomorrow. Let me know what you think. I'm probably going to invest into this company. I like to do this because it keeps you sort of in check to make sure that you're making decisions rationally rather than just sort of going out and thinking that you're some type of big shot guy on Wall Street or something, that you're going to make tons of money, because the truth is a lot of people lose their shirts, especially when starting in investing, and it's hard to beat the markets. So it's always important to get other people's perspectives and bring those in. This actually happens to people regardless of how much money you have. If you have $500 or if you have billions of dollars, this happens to a lot of billionaires. Look at Donald Trump and his Taj Mahal project with Atlantic City. Didn't work out so well. He was way too overconfident and it was a terrible, terrible investment from what I think we all understand. So that's just one of the points there that we wanted to make, that it's important to not be overconfident in your abilities, to make sure that you're always checking yourself and reaching out to others to get their opinions on investments that you are about to make. Now, the next mistake that people are making is they're afraid to cut their losses. Now, there's actually something that we call cognitive error in behavioral finance, which kind of goes into this, and a reason why people actually are afraid to cut their losses. For example, when I got off the plane last week from Europe, I know I shouldn't have been in Europe. Yeah, obvious, okay, we don't have to talk about that. It was not that bad when I went over there. But the point here is that people end up afraid of cutting their losses. And so when I got off the plane from Europe last week and I went to New York and I went pretty much just straight home, but I saw people everywhere just like clustered together. Like the bars were crowded. Everybody was just like out and about, just like together everywhere. And that's when I realized it's probably going to get pretty bad in America. So I lessened some of my positions in some highly leveraged companies, even though I was already down 25% or 30% on a couple of those that I sold. Luckily, I did that because it went down quite a bit harder in the past week. But trust me, I'm no genius. I lost plenty of money in a lot of other companies. So, I still took it at a loss. But the point there is that it's okay to take some investments at a loss. Now, should you sell all of your stocks at a low? No, definitely not. Well, actually, it's up to you on how you want to do that. But that's just something that I really think is important to remember, because I see far too many people who will buy a stock, realize maybe a week later, a month later, or at some point in the future that, wow, this is not a good investment. They say, I'm just going to wait until it gets back up to what I bought it at. And when it gets up to the price that I bought it at, I will then sell that stock and I'm going to get out of it. But I just need to wait so that I can break even, because I just don't want to take it at a loss. That is a mistake that people make all too often. And it ends up turning into what we call a falling knife. If you're interested in falling knives, just do a quick Google search. But essentially, it's when there's a company or a stock that you own that's going down to zero, they're going to go bankrupt. It's just a matter of time, but you're too sort of stubborn to realize that, or to let yourself think that or believe that, and you just kind of turn the other way and don't think about it while your stock just continues to decline. Sorry, I'm losing my voice here. I'm a bit sick. So the next problem that people face, or the next mistake that people make, is they end up focusing too much on the macro and not enough on the micro in regards to investing into individual companies. So I'll give you an example here. Let's take airlines, okay? So some people are so focused on the macro, so focused on the overall airline industry, and they're thinking, they're looking at overall airline stocks at the moment, and they're thinking that the airline industry is expected to grow double by the year 2035. Projections look pretty good over a long period of time. Obviously, there's a little bit of a hiccup, or a pretty big speed bump right now in the airline industry, but they're looking, 90% of their energy and effort is going into researching about the industry rather than actually looking at the individual company. So they make decisions based off of the industry rather than the financials and looking deep into an actual specific company. Hopefully you see what I mean here, that it's just as important to focus heavily on the micro, if not more on the micro, instead of macroeconomics, focusing on the big overall picture of where the US economy is going to be in 5 years, but more so thinking about that individual company. Because the truth is, well, maybe not airlines, but there are companies that are going to be profitable even in the worst recessions. Even in depressions, there are going to be companies that are growing, that are actually hiring more employees. They're bringing on more employees because they need to handle all of this demand that they're facing. For example, Walmart, Clorox, we saw with this one. But so there's always going to be companies that can be thriving during recessions. So instead of thinking about the big picture about how a lot of stocks have gone down, think about the companies that right now are flying under the radar or are undervalued at the moment and can be turning profits, quite considerable profits, even during recessions. So this next mistake is when people end up investing money that they cannot afford to lose. This one really pains me a lot. I really hate to see this happen. But look, the most important thing when you get paid is to make sure that you cover all of your expenses, that you save a little bit of money, put some in the bank, put some in your checking account, make sure that you have your retirement accounts funded, then thinking about investments. But please, please, please don't invest money that you cannot afford to lose. I sleep extremely well at night because I know that I have all of my bases covered. I know that I have a good amount of cash. Then I can invest money. And all of this money that I'm investing is all money that I can afford to lose. So if I'm losing $4,000 overnight, I can still wake up in the morning knowing that I'm able to pay my bills, pay my rent, pay for everything without having that problem that some people are going to be facing. Now, I don't know why people do this, but I've literally seen people who will take out a cash advance on their credit card. They'll go to an ATM, they'll pull out cash with their credit card, and then with that, they will invest money into the markets, or they'll buy Bitcoin, or they'll do something with this credit card that they'll end up losing money in their investments, and then they still owe money on their credit card payment, and it's just this double whammy, and they really end up shooting themselves in the foot. So don't borrow money to invest. Investing on margin, extremely, extremely risky. Some people can pull it off, but please, going back to the one point that we made earlier about overconfidence in your own abilities, especially if you're first starting to invest into the stock market, buying on margin, borrowing money to invest, try to avoid it unless you're extremely experienced, and even at that point, it's so risky to the point where I just don't think it's very much worth it. So another problem that people face is they end up reacting emotionally rather than using logic. Now, I actually fall into this category a bit as well. I think most investors at some point will sort of succumb to emotions rather than using logic long term, but it happens to everybody. Now, the way that I combat this is by keeping a journal. So I actually write down most of the investments that I make, especially if they're large investments. I will write it down in my journal, the reason why I bought it, my thought process, the price I bought it for, but just to kind of refresh my mind. So later on, if I'm thinking about selling it, I can look at this and I can look back on the previous months and previous years of my investing decisions to see how I was acting. And so if you're looking back on this event that we're facing right now at the moment, this recession, and you're looking at your journal from 3 years ago and you're thinking, wow, I can't believe how emotional I was when I was going through that moment in 2020, in the spring of 2020, and what was going on. So just make sure that you are using logic rather than emotion. And trust me, there's plenty of things that are going on at the moment that are very, very much logic and not emotion, but just make sure that you are kind of balancing those out. And look, I find myself sometimes refreshing CNN like 50 times a day, just refreshing the news, looking at how terrible the news is in the world, and it can get quite distracting kind of just with all of this information coming in at all the same time. Now, the last pointer that I want to leave you with, a mistake that people actually make is they end up kind of avoiding financial advisors because they think that financial advisors are going to charge them large excessive fees. Sometimes that is the case. Sometimes if they're sitting there with $500,000, I don't know who just inherits $500,000, but sometimes people do. There's people on this channel who have millions of dollars. I don't know why they'd watch some schmuck on YouTube, but hey, okay, all right, I should be nicer to myself here. But it's okay to go to a financial advisor, especially people like fee-based financial advisors where maybe you pay them a few $100s and they're going to kind of look over your portfolio, look over your investments, and give you some pointers on, maybe how they would personally invest that money. If you are extremely risk averse, or if you are old, or if you are young, they're going to give you different pointers on how you can balance your portfolio best, especially during these turbulent times. So if you are sitting on a large amount of money, I would personally say if you have 6 figures, if you have over $100,000, I would definitely consult with the financial advisor at some point. But if you're sitting there with $500, a financial advisor doesn't make very much sense because, well, damn, they're going to take all of your money just as an investment advisor's fee. So hopefully you found some value in this video. If you did, don't forget to hit the subscribe button, drop a like if you enjoyed the video, and I'll see everybody at some point later on this week. I don't know when we're creating more videos, but we'll see how the week goes. Hopefully it's not as turbulent as what it's been this past week. So thanks for watching, and I'll see everybody next time.